I decided to do this talk for several reasons. First of all, I thought it would be interesting. But secondly, I get very frustrated by the number of people who talk about Islamic finance, but without looking at the facts. They ignore the data and just theorize. And what I wanted to do was to do the opposite, to ground the talk in hard, detailed information. So, having spent over 30 years as a professional tax advisor, you're continuously paranoid about the risk of being sued. I don't think there's anything that I'm saying tonight which could possibly constitute advice, but just in case anybody thinks I am, here is my first disclaimer. You cannot sue me for anything that I might say. A more serious disclaimer, I know both banks extremely well. I know the management of these banks, I've known them for many years, and inevitably over time you acquire quite a lot of information, not all of which is in the public domain. There is nothing that I intend to cover tonight which is not public domain information. Everything I'm going to say, everything I'm going to show you is all straight from the published accounts that every person in this room is able to go and get from these companies' websites. The issue is that most people don't bother. They don't bother looking at the facts. So, first of all, just some brief details about me, most of which have been covered. I then want to start, not with the subject matter of the lecture, but just a reminder about what banks do. Because again, especially in the area of Islamic finance, people don't seem to focus on the fact that Islamic banks are banks. And they have to succeed or fail as banks. And then we're going to look at the accounts. So, that's me. Key things in this context are that I'm a chartered accountant, used to reading accounts as well as being a tax advisor, and of course the address of my website where a lot of the stuff that I write on Islamic finance ends up. So, the business of banking. Banks are businesses whose purpose, they have the same purpose as every other business. A business exists for only one reason, and that is to make money. If it doesn't make money, it has no justification to exist. And banks make money by charging people fees for services provided. They may store your gold for you and charge you every year for keeping it. They invest in things on their own account. They buy things and hope those things will go up in value or produce an economic return. That's called principal investing. And they engage in transformation of credit risk and transformation of maturity risk, which I'm going to illustrate. So credit risk transformation, banks take money from people like you and pay you very small amounts of money for taking that, because the bank is allegedly a low-risk borrower of money. And then they lend that money to other people who are allegedly higher risk and charge those people higher rates of interest, and they keep the difference. That's what conventional banks do. That is also what Islamic banks do. The only difference is that Islamic banks do it in a Sharia-compliant way. Secondly, banks engage in maturity transformation. Banks will take money in, which is repayable very quickly. A lot of it, like your current account, is repayable on demand. But even when it's interest-bearing money, if it's repayable very quickly, you can see that the rate of interest for short-term money is very low. That's the current yield curve from the Bank of England website, the interbank market, and the interbank market is about 1%. You won't get even 1% if you put money into a bank for short-term interest rates. You will get a tiny yield. If that money is lent out on a 10-year basis, in the interbank market, you can earn 3.5%. And what's striking is that that is 1.5 percentage points lower than a year ago when I used this slide. And that's an illustration of market conditions, the Eurozone crisis, quantitative easing, you name it. And it may look risky for banks to take in money repayable on demand and lend it for 10 years, but provided you manage the numbers right, you can survive. And you can make money doing it. So, on to the accounts. The first thing is, what do these Islamic banks do? And this is what they say themselves about what they do. This is a straight copy of the principal activities note from the Director's Report in Islamic Bank of Britain's accounts. It's a retail bank, so it deals with people like you and me. It offers all kinds of services, including current accounts. That's the real test of a retail bank. They offer checkbooks, savings accounts, home purchase plans, etc. They have branches, and we'll talk about the significance of having branches later on, but the key thing about branches is that they cost money. They involve rent, electricity, and people. And they have other channels as well, internet, telephone, postal, as well as agents. Bank of London and the Middle East is quite different. It's striking that they spend the first half of that note just telling you about their history, because they only start telling you what they do in the second sentence. BLME, an independent wholesale bank providing Sharia-compliant banking services to businesses and individuals. Now, IBB also provides services, but they provide services to individuals and businesses. And the order in which those two words appear is quite significant, because most of IBB's customers are individuals, most of BLME's customers are businesses. And with a strong focus in Europe, Middle East and North Africa. BLME doesn't need to be here as far as its customers are concerned. It's operating internationally. The only reason BLME is in London is because it's a good place in terms of reputation, although that reputation might be going down at the moment with things like the Barclays crisis and so on. It's a great place to buy professional services, lawyers, accountants, actuaries, you name it. It's a great place to hire bankers, because we have lots of bankers. But that is why BLME is here. It is not here because its customers are here, although it does do business with UK-based customers as well as foreign customers. IBB, going back to its business, has to be here. It's offering retail banking services to people like you and me, and people like you and me do not buy our retail banking services from companies based in France or Germany or the Netherlands. It's completely impractical. So IBB has to be here. BLME is here by choice and could be operating from somewhere else quite easily. The next thing I wanted to look at was who's in charge. So again, all I've done is go to the accounts and list out year by year who was in charge. And IBB is the older of the two banks, so in 2004 and 5 they had Michael Hanlon. In 2006, they actually did have Michael Hanlon for the whole of the year, because the accounts say that he resigned on the last day of the year. But I put vacant in that list because if some people don't just resign on the last day of the year, I suspect he was, I'm guessing now, but I suspect he was in the process of leaving or whatever. But nevertheless, there was a change. Then for 4 years they had Jerry Deegan, and then they changed to Sultan Chowdhury. Whether you regard that as a high degree of change or a low degree of change is a matter of opinion. I personally regard it as a high degree of change. Compare that with BLME, where from day one, which is 2006 for BLME, the same person's been in charge all the way through, Humphrey Percy. The other important role at any bank is who is the finance director or chief financial officer. And IBB started with no director in that role. It doesn't mean that they didn't have a head of finance. It's impossible to believe that the Financial Services Authority could license a bank without somebody being responsible for the finances, but there was no person at board level who was the finance director. Then for 2 years they had Ashraf Kirani, and then again they had nobody. Now I know the name of the person who is head of finance at IBB, or was a few years ago certainly, but That person is not a director. There is no director stated as being responsible for the finances. Again, BLME, the same person, Richard Williams, has been finance director all the way through. And the purpose of tonight's talk is not to throw stones or brickbats at any bank, but from a personal point of view, I find it very strange that you can have a bank where the person who's in charge of finance for the bank is not a board level position. Because it doesn't matter how good that person is, if they're not around the boardroom table, they will be regarded as of lower status, they will be listened to less, and I personally find that very strange. Let's look at the size of these two banks. And there are two statistics I want to look at. The first one is total assets. That is everything that the bank owns. And we'll look at the assets in a moment. And you see that BLME is much bigger than IBB. It's 4 times the size. But secondly, look at the shareholders' funds. IBB has shareholders' funds of 17 million. Now, if I had 17 million, I would go and celebrate, and I would feel rich. But for a bank, 17 million is not a lot of money. That is the banking equivalent of running on a shoestring. Compare that with BLME, shareholders' funds of 239 million, and then look at that ratio of shareholders' funds, the equity, to total assets. BLME, almost 30%, IBB, 7.8%. Before we look at anything else, what that will tell you is that IBB can afford to take far less risks than BLME. When it acquires assets, it has to seriously worry about those assets falling in value. So let's take a simple example. If IBB's assets, 217 million, fell in value by 10%, that is 21 million pounds. If it lost 21 million pounds, it would have negative shareholders' funds of 3 million, it would be bust. If BLME's assets, 807 million, fell in value by 10%, that is 80 million pounds. 80 million pounds is a very painful thing to lose, but it would still have positive shareholders' funds of about 150 million pounds. I'm not very good at mental arithmetic, I'm standing up. But it would still be solvent, it would still be in business. That's an illustration of the fact that when you have much higher equity in relation to total assets, you can afford to take more risks. Liabilities. Those total assets of 807 million or 217 million, they're financed partly by the shareholders' fund, and the rest of it is financed by other liabilities. Now, in the case of BLME, BLME gets its money almost entirely from other financial institutions. It goes into the interbank market and basically it borrows money. It doesn't borrow interest-bearing loans because it's a Sharia-compliant bank. It will engage in Sharia-compliant transactions like Bakala or commodity murabaha to obtain money from financial institutions. It also has 50 million from customers, and if you go to the Bank of London Middle East website, you'll see that they are willing to take deposits from you, from memory, if your deposit is at least £25,000. But they're not interested in deposits from ordinary low wealth individuals because it's just too much hassle. So 25,000 at least or nothing. But in BLME's case, because it's so easy to raise money in the interbank market provided your credit is good, what drives BLME's business, just from looking at these accounts, is the assets. So it decides to acquire an asset, and then it goes into the interbank market and gets the finance that it needs to have that asset. And if the asset disappeared, for example, if it repaid and it didn't have a new asset, it would simply pay down its interbank liabilities. So BLME as a business will be asset driven, and we will look at what those assets are in a moment. IBB is different. If you look at IBB, it's got next to nothing in the interbank market. Its money comes from customer deposits, either non-profit sharing or profit sharing. And The non-profit sharing will basically be current account money, and the profit sharing will be customer deposits on a Madaraba basis. So, and if you're running a retail bank, if people put money into their current account, or even if people put money into their savings account, you can't turn them away. IBB doesn't say £25,000, oh, we don't want your money. If you're a customer, if you've got a savings account with them, and if tomorrow you put £10 into your savings account, they have to take the £10. So IBB is driven by the fact that it has these liabilities, and it cannot control those liabilities. If people put money into the bank, its liabilities go up. That's the nature of, debits and credits. And it then has to think about what to do with the money when it comes in, subject to the fact that it can't take much risk because it's got low equity. So what does it do? What do both these companies do with their money? If you look at BLME and its balance sheet in terms of the assets, 174 million with financial institutions, that is effectively its liquidity buffer. With a bank, you always need to have cash that you can get hold of very quickly, either because people want their money back, or you have some kind of problem. You need a liquidity buffer, and that's what I talked about last year. And similarly, IBB has got 144 million of liquidity buffer as well. But that is more than it probably wants. Because for the rest of the balance sheet for BLME, the investment securities, the financings, those are things that it wants to have. It wanted to acquire those. It wanted to engage in commercial property finance, have these finance leases, operating leases. Those are the assets it wanted, and then it went and got the liabilities in the interbank market, the 500 million we saw on the previous page. In IBB's case, it's the other way around. It can't help having 216 million of total assets, because that's the money that customers have chosen to put into their accounts. It's managed to lend out 61 million as home purchase plans and 7 million as commercial property finance. The rest of it has to go into the interbank market because it has to be very choosy about what kinds of assets it acquires. So, and you can see that on this slide, BLME, 67% of its assets are real proper financing, and the rest is money in the interbank market. The sort of balancing figure, as it were. In IBB's case, only 69 million is real things that it actually wants to do, which make it money. The rest of it has to go in the interbank market, because where else are you going to put it? Banks don't put money under the sofa. What return does it get on its assets? Looking at the total assets, you look at the total income, what's coming into the bank, and BLME has a 6.7% return on its total assets. And that's averaging everything. The interbank deposits, which earn next to nothing in today's interest rate environment, plus the leasing, the financings, etc. Compare that with IBB, where the rate is 1.7%, partly because IBB has lent out a lower proportion of its assets. It's only really lent out 32%. But secondly, it's because those assets are lower yielding assets. BLME's assets, just looking from these percentages, will clearly be riskier assets than the IBB assets. And that ties back to the details. If you look at these assets in detail, leasing things is inherently riskier than financing home purchases by private individuals. Buying sukuk in the interbank market is, buying sukuk is inherently more risky than home purchase plans. But if something is more risky, it will have a higher return, but you have to worry about the risk. Operating costs in relation to assets. BLME's operating costs are much lower proportionately than IBB's. And the reason for that is that, first of all, BLME has got a lot more assets. It has a much larger balance sheet. It's been able to expand its balance sheet because it's engaging in large-scale transactions. What IBB has got is lots of branches. Branches equal operating costs. That's why its operating costs are 5.1% of total assets. And if IBB is earning 5.1%, sorry, it's suffering operating costs of 5.1% on its assets, while earning 1 point something percent, you can expect it to have a problem. While we've got income to assets here of 6.7% compared to operating costs of 2.2%. Of course, BLME's also got financing costs, which I've ignored. And IBB's got financing costs, which I've ignored. These are purely the operating costs. Couldn't resist this one. This is the total payroll cost compared to the number of people. So the average person at BLME is being paid $135,000 a year. The average at IBB is $35,000 a year. That's because they're different kinds of people. At BLME, you're talking about secretarial support, and then the rest of them are real bankers, investment bankers. IBB has got a large number of branch staff, and they are not real bankers. Somebody who sits behind a bank counter and takes in money and pays out money is a person who's simply shuffling paper. They're not a real banker. They're not taking banking decisions. So IBB has a large number of low-paid staff as well as a few real bankers. BLME has a lot more real bankers. Cost of funds. This comes back to the liabilities. BLME is paying 1.7% for the 568 million of external liabilities that it has. IBB is only paying 0.8%. That's because BLME, when it borrows, is borrowing in the interbank market. In the interbank market, banks want to be paid a proper rate. And it's borrowing from high net worth individuals who are only depositing £25,000 upwards because they're getting a reasonable rate. IBB, the deposits are coming from people with current accounts who get nothing, and depositors with fairly small amounts of money who would be paid very little if they went elsewhere with the money either, so they get paid very little by IBB. That's why these cost of funds are so different. And finally, how are they doing? IBB, as you can see, has lost money every single year of operations, and it's lost it in a very consistent kind of way. Because it hasn't gone out and done stupid things. It's simply running a branch network which involves too many employees and too much electricity and rent for the volume of business that is going through the banking system. And because its capital is so low, it finds itself unable to lend out most of the money that it takes in to do things that earn a reasonable economic return. BLME is different. It has, in some years it's made money, but never spectacular amounts of money. I mean, the highest year we've got there is 3.5 million. Well, with 280 million of shareholders' funds put in, if it was earning even 1% on shareholders' funds, it would have a profit of about 2.8 million. It's not. Given that banks like HSBC, Barclays, Lloyds TSB aim to have a return on equity of 10 to 15%, you can see how poor BLME's results are even in the good years. And then you can see that there are 2 years which are catastrophically bad. So net, BLME, like IBB, has simply lost money for its shareholders. And in those 2 bad years, those losses come entirely from impairment charges. Because again, these figures from the account show that if you added back the impairment charge in those 2 loss years, there would have been a profit of about the same sort of size as we saw in the other years, 2.1 million, 4.4 million. What's caused those impairment charges? BLME tells you. In 2009, 4 facilities totaling 37 million were impaired. Now, they weren't totally written off. There wasn't a 37 million impairment charge. The impairment charge was only 21 million. And of course, that 21 million covers not just the top paragraph, it covers the other paragraphs as well. So then smaller things like Sukuk and a US lease portfolio, but nevertheless, big chunky transactions. Because that's what investment banks do. You do big chunky transactions, and if even one of those goes wrong, it can be very expensive. Similarly, in 2011, at that stage they were counting 6 impaired facilities, which total between them 40 million. So a few transactions that have gone bad, or look as if they're going bad, can cause enormous impairment losses. So to summarise, Islamic banks are businesses and their purpose is to maximise shareholder value. Although so far, as you've seen from the accounts, these banks have not yet succeeded in maximising shareholder value. They've got the same commercial challenges as conventional banks, and to succeed in running an Islamic bank, you need the same kinds of skills as you need to run a conventional bank successfully. You need a strategy, you need good HR management, you need good risk management, you need to be able to segment your customers and know who they are, etc. So at that, I'm going to stop and throw it open to questions and answers for the last 10 minutes.